A three-digit number is following you everywhere. It decided your car payment. It decided your apartment approval. It shaped the interest rate on your credit card, and you might not even know what it is. Your credit score? Most women have never been taught what it means. Nobody explained how it works or why it matters, but the banks know your number. The lenders know your number, the landlords know your number, and every single one of them is using it to decide how much you pay. That silence, that gap in your education, is costing you thousands. Your credit score is a number between 300 and 850. It tells lenders one thing: how risky it is to lend you money. The higher the number, the less risky you look. The lower the number, the more they charge you. That is the entire game. According to Experian, the average credit score for women in America is 705. That sounds decent, but decent is not good enough. Because the best interest rates, the ones that save you real money, only go to people above 740. Below 670, and you are in what lenders call the subprime zone. That means higher rates on everything: your car loan, your mortgage, your credit card, even your insurance. A 2023 report from the Consumer Financial Protection Bureau found that borrowers with scores below 620 pay, on average, 3 to 4 percentage points more on auto loans alone. That does not sound like much. But over 5 years on a $25,000 car loan, that is an extra $4,000 you are handing over. For the exact same car, same dealership, same Tuesday afternoon, but a different price because of a number you were never taught to manage. Your credit score is built from 5 factors, and most people only know about one of them. The biggest factor is your payment history. It makes up 35% of your entire score. Every time you pay a bill on time, it helps. Every time you miss one, it hurts. Even one missed payment can drop your score by 60 to 100 points. And that missed payment stays on your report for 7 years. The second factor is how much of your available credit you are using. This is called credit utilization. It counts for 30% of your score. If you have a credit card with a $5,000 limit and you are carrying a $4,500 balance, that is 90% utilization. The scoring system sees that and panics. It wants you below 30%, ideally below 10%. The third factor is the age of your credit. It counts for 15%. The longer your accounts have been open, the better. This is why closing an old card can actually hurt you, even if you never use it. The fourth factor is your credit mix. That is 10%. The system likes seeing different types: a credit card, an auto loan, maybe a student loan. It shows you can manage variety. And the fifth factor is new credit inquiries. That is the final 10%. Every time you apply for a card or loan, a hard inquiry hits your report. 1 or 2 is fine. 5 and 6 months. That looks desperate to lenders. Now here is what matters. The first 2 factors alone, payment history and utilization, make up 65% of your score. That means 2 habits control almost everything: paying on time and keeping your balances low. Everything else is secondary. Now let us put real numbers on this. You want to buy a home. The price is $250,000. You put 10% down. That is $25,000. So you are financing $225,000 over 30 years. If your credit score is 760 or above, you qualify for a rate around 6.5%. Your monthly mortgage payment is about $1,422. Over 30 years, you pay a total of roughly $512,000. That includes $287,000 in interest alone. That already stings. But now, imagine your score is 620. Same house, same neighborhood, same $225,000 loan, but your rate jumps to 8.1%. Your monthly payment is now $1,672. That is $250 more every single month. Over 30 years, you pay roughly $602,000 total. That is $377,000 in interest. Let that difference land. With a 760 score, $287,000 in interest. With a 620 score, $377,000 in interest. The gap is $90,000. For the exact same house, you did not get a bigger kitchen. You did not get an extra bedroom. You got the same house with a $90,000 penalty. According to data from Freddie Mac, borrowers in the lowest credit tier pay between $70,000 and $100,000 more over the life of a standard mortgage. The average lands right around $83,000. That is not a rounding error. That is a down payment on a second home. That is 4 years of college tuition at a state school. That is retirement savings you will never get back. And it all comes down to a number that nobody bothered to explain to you until now. The credit system was not built to help you. It was built to measure you. And the people who profit from low scores have zero incentive to explain how it works. Think about it. Credit card companies make money when you carry a balance. The average credit card interest rate in 2024 is 24.7%. That means if you carry a $5,000 balance and only make minimum payments, you will pay over $7,300 in interest alone. The credit card company does not want you to pay it off. They want you to keep that balance right where it is. Auto lenders do the same thing. They offer you a longer loan term to make the monthly payment look smaller. But that lower payment means more months of interest. A 72-month car loan at 11% means you are paying thousands more than the car is worth. And the credit bureaus themselves, the companies that generate your score, they also sell you monitoring services. According to a Federal Trade Commission study, 34% of consumers had errors on at least one of their credit reports. 1 in 3 people. Errors that could be dragging their scores down for years. And you have to find the mistake yourself. You have to file the dispute yourself. Nobody is checking for you. The system makes money from your confusion, from your silence, from the fact that nobody ever sat you down and said, this is what your credit score means, and this is how you protect it. Now, the biggest objection people have is this. They say, my credit is already messed up. It is too late to fix it. That is not true, and data proves it. A study from the Consumer Financial Protection Bureau found that most people who actively worked on their credit saw improvement within 3 to 6 months, not 3 years. 3 months. Your score is not permanent. It is a snapshot, and it updates every 30 days. So here is what you do. Step 1. Check your credit report for free. You can do this once a week through the official annual credit report site. Look for errors, wrong addresses, accounts you do not recognize, balances that seem too high. If you find a mistake, file a dispute. The Bureau has 30 days to investigate. According to that same FTC study, 20% of people who disputed errors saw their score increase. Step 2. Set every single bill to autopay. Your payment history is 35% of your score. One missed payment can drop you 100 points. Autopay eliminates that risk entirely. Even if you only autopay the minimum, that counts as on time. Step 3. Get your credit utilization below 30%. If your card limit is $3,000, your balance should stay below $900. If it is above that right now, focus your extra cash on paying it down. Even a $200 payment this week changes that ratio immediately. These are not complicated steps. They are not expensive. They just require you to know they exist. And now, you do. 2 people, both earning $55,000 a year, both living in the same city, both starting with a credit score of 620. Person A ignores their score. They keep carrying high balances. They miss a payment here and there. After 5 years, their score sits at 610. They buy a car at 11% interest and pay $4,200 extra over the loan. They rent an apartment that requires a double security deposit because of their score. When they finally apply for a mortgage, they get an 8% rate. Their monthly payment is $1,672 on a $225,000 loan. Over 30 years, they pay $377,000 in interest. Person B takes action. They check their report, dispute 2 errors, set every bill to auto pay, and pay down 1 credit card. After 6 months, their score climbs to 680. After 2 years, it hits 740. They get a car loan at 5.5%, saving $3,800 compared to person A. They qualify for an apartment with a standard deposit. When they apply for a mortgage, they get a 6.5% rate. Monthly payment, $1,422. Over 30 years, they pay $287,000 in interest. Same paycheck, same city, same starting point. But person B keeps an extra $90,000 in her pocket over her lifetime. The only difference is that person B learned how the score works and took 3 simple steps. Your credit score is not a judgment of who you are. It is a tool that was hidden from you on purpose. Because when you do not understand how it works, somebody else profits. But today, you learned the 5 factors. You learned the math. You learned the steps. You are not someone who ignores her credit score anymore. You are someone who knows exactly what it means and how to use it. This is not your fault. Nobody taught you this. But starting today, you know, and knowing changes everything.